This is Akshay. Thanks, Raj, for my introduction, and good evening to all the viewers. First of all, thanks for giving your time out to JM Financial for listening out to us. So, we have been bang on till now on all our views, which we have been giving out time and again since the last three monthly webinars. And I hope this has benefited you all the way the markets have been. Our job is to show you the path for how we are looking at the month of November and best place you in terms of the trades, the sector watch, which sectors you should be looking forward to, the option strategies which you should be building to safely go through the month of November. And lastly, we would also like you to understand the important key events which you need to be plugged in to be in tune with the market. Now, first of all, let's take a broader technical and view on the price charts on the Nifty index. And we'll also see how the derivatives data is placed for the month of November. So till now, September month has been a one-way month for the Nifty index. It's been a smooth sail for the Nifty. From 24,600, we conquered the landmark of 26,000. There has been some profit booking in today's trading sessions at the levels of 26,100 odd levels. We are around 25,750 as we close today. So it is just some bit of a minor dent which is in place. But what my belief is that considering the one-way rally which we had in the last 10 to 12 all trading sessions, this is a moment of a pause, or we call it a consolidation move, where the Nifty is taking a breather before it sets its next chart of direction. So right now we are dealing with an important support zone which is around 25,700. On Monday, we see how this support zone plays out, and we will guide you on the important levels as we progress in this seminar. Now, important thing from the derivatives angle would be to keep a tab on the volatility index, which we call it the India VIX. VIX, which has been at the bottom of 10 odd percent since the last couple of months, is slowly showing its intent of a minor bump up. From 10% to 12% has been the recent journey of VIX. And VIX, if it were to go from here, if it were to pick up from 12 to 14, 15%, that would mean that there can be a possible short-term correction in the market. So VIX is at its base. It is slowly moving up. This is one concern or a red flag which traders need to keep at the backdrop as we head into the month of November. How the rollovers have been for the month of November. Now, rollovers are how the positions which have been moved from the month of October to the November series. Now, if you recollect, October was a month where there were a lot of short bets in the market. In fact, FIIs have been known to be strongly short on the Indian markets. And November move, the positive move was largely on short covering in the initial phase. And in the last 5-6 trading sessions, we did see positive buying intent in the Nifty. Hence, the rollovers of 76%, which we see, might seem a bit lower than the average 3-month rollovers of 80%. But what our sense is that on an average, 25,800 plus minus 100 points has been the level where the positive rolls have taken place to the month of the November series. However, the rollovers are not very aggressive, let me tell you. They are slightly lower than what the normal averages are. So it means that there has been a positive intent of moving buying positions to the November series, but the aggression is a bit lower than the 3-month averages. So our thought process is that looking at the technical setup, looking at the derivatives rollover positions, we believe that for the month of November, Nifty might be range bound. So we are talking about a month which is likely to be consolidative. We are talking about times where it will be a month where it will be a bit choppy. Buy on support, sell on resistance normally is the flavor in such type of months. Important thing to note is that 25th of November is the expiry for the Nifty index. That means that with a couple of holidays which are lined up in the month of November, we are in a month where the number of trading days are lesser than what the normal series has. And normally my take has been that whenever the number of the trading days are lesser, it ends up as a range bound month because the option premiums are slowly picking up, and traders do feel that if it is a short month in terms of number of trading days, why not buy options? But markets doesn't think the way we want to, and historical data says that uh, it tends to be more of a range bound month. So we are staring at a month where the supports of roughly 25,400 can be the possible lower end of this range, and 26,300 can be the possible upper end of this range. So this is good news if you are an option seller, or if you're an option writer, because the last 1.5 month has been very hard on option writers, especially when a one-way directional move kicks in. It hurts when you set positions where you sell calls and you sell puts with an anticipation of a range, and the directional moves just completely ruins this particular short strangle strategy, as we call it in the derivatives theory. So this is the month where I feel the short strangles or the range bound strategies will work the best, where you set a call selling and a put selling strategies for a defined range, and we benefit from the time value depreciation. So the anticipated range for the month, as I mentioned, is 25,400. That's the lower end of the base we are looking at, and 26,300, which is the upper end of the range. And within this range, you are going to have a phase in Nifty index, which will be choppy, directionless all across the pace, and we will be just in the process of figuring out which way actually markets would go. But options data has a lot to say, and this is what it has to say, that be prepared for a range bound month. Now, even if you look at the seasonality aspect, November is a month where traditionally it's more of a neutral setup. Overall, the tinge to the build up for the closing fag end of the year is positive, but seasonally it's more of a neutral month. So this boards with our range bound view as well. And Bank Nifty, which is the leader normally of the indices, because when Bank Nifty takes the lead, whether it is downside or it is upside, we get some cues as to how things are playing out for the next few trading sessions. So Bank Nifty has seen that corrective intent, profit booking in the last few trading sessions, and that just makes us believe that the leader is stepping aside, the leader is taking a backseat, and overall the market breadth, the way the slight profit booking tinge is seen in the market in the last 3-4 trading sessions at the beginning of a new series, just makes me believe that Bank Nifty 2 might be a range bound month. There might be some profit booking intent in Bank Nifty at the current levels. Slight dip of 500-800 points is possible from the current rates. But overall, the flavor is we are looking at a range bound month, even in the Bank Nifty, where your option short strangles or range bound strategies work the best. So be brave enough to set those strategies. If you're an option writers, things should work well for you in this month. The open interest placement for Nifty for the month of November is signaling that 25,500 is possibly the base where the put writers are setting up their writing bets, and 26,500 is where the call writers are defining the resistance. So clearly, the technical piece of data, the derivative piece of data are all adding up and exactly pointing us to the range I mentioned. Now, really we're talking about what should we do in such kind of a range bound markets. Now it's very difficult to pick stocks here because as I understand, looking at the flavor of the market, it is not a sector specific market anymore. Sector specific markets work best when there is a direction set in, when there is a direction rolling out. If you look out at the markets in the last couple of months, there was a theme in the market. We started off with banking, then came metals, then there was a slight bump up in the power sector lately. So market works on themes, on sectors. But when you get into a situation where the markets get into a range, sector specific approach is not the way to go, at least for the month. So my thought process is go for stock specific approach rather than sector specific approach, because spotting sectors in a range bound month becomes very difficult. Now, if you still were to micro inspect and try to find out where the green shoots in such a market would be, I think pharma is the place to hide or to bet on the long side in a range bound or a choppy Nifty index. So I believe looking at the derivative setups, the way the technical setups of most of the names in the pharma stocks are, these are the stocks where you can see some bit of a positive uptick in the month of November. So stocks here, you have to be very specific. We are giving out calls, some open calls which we have in the pharma space can be a Glenmark Pharma, which is heavily oversold, and is showing some buying at lower end, which is evident based on our derivatives data piece which we follow. So I think Glenmark is poised for a recovery. Lupin has built a good short-term base and is setting up for a strong momentum uptick. So we have Lupin to call, which we recommended in the vanilla option segment today, where it has moved very positively in our direction today. Aurobindo Pharma, which has moved well today. We did recommend today in our Hero Zero basket. That can be another name which you can look forward to. Divi's Lab has noted long additions in the last three trading sessions. So one more pharma stock where the momentum is strong. And Biocon can be the third name, where we had a buy call from the technical desk in our team, where there has been good healthy gains. So I think pharma is the sector to be in. But again, you have to be very specific about the names you choose, and we are there to guide you on this. Do follow and be informed as to where exactly which stocks we are looking at from the pharma sector, and I'm sure that it will help you tremendously in your trading journey. Next can be FMCG and the mid-cap banking space. Now, FMCG has not shown any green shoots as of now, but if you recollect 3-4 days back, Varun Beverages strongly moved up. United Spirits has a positive data piece after its news of quarterly numbers. Then comes ITC, which is a slow-moving counter, but suddenly picks up momentum in the last 4-5 sessions. So there are stock-specific names in the consumer durables as well. A Tata Consumer, which is closely poised at a breakout zone. We need to monitor how it breaks out, but overall, I think FMCG can be the space where you can see some buying intent in the month of November. Nestle, Britannia, Dabur, these can be other names which you might consider, where we have a couple of open recommendations as well from the technical team. And these are the setups which I believe can work well for the month of November. Mid-cap banking space, especially the small run banks to the name of a Yes Bank, or you can say a bank like CUB, which is a City Union Bank, then IDFC Bank, IDFC First Bank, where we have Hero Zero in our stock options basket, and IDBI Bank. So these are banks which have been dormant for long, and suddenly there has been a momentum catch-up, derivative long additions in the month of November. So these are names which you can look forward to from a positional perspective. So pharma, FMCG and mid-cap banking. Be posted on long side in these three names for the month of November is what we are recommending based on our technical and derivative recommendations. Now, sectors which have moved up a lot, where there can be some profit booking. We are not telling you to go and all out and short these stocks, because the technical setup is still positive. What's slightly worrying is that they have pulled beyond anticipated moves. They are overbought on the price charts. There is a chance that these stocks might be consolidating or might face a loss of momentum for the next few days. And probably that is why you need to micro time them. If you are a trader, book your profits out and look for re-entries on lower end. So some of the sectors which can be vulnerable for that profit booking if it does happen. I'm not talking about any major V-shaped fall. We're just talking about a sideways or a temporary profit booking phase, considering the large run-up which most of these names have. So large private banking names, these can be the names where there can be vulnerability to profit booking. Metals, fantastic, fabulous run-up in the last few days. They can be slightly vulnerable to profit booking. So if you have positions in them, look for booking out. If you're not very keen on booking out profits, you have them in your portfolio. Be open to selling calls which are at least 5-8% away from current market price, so that even if these were to go sideways, even if they were to correct a bit or show moderately upside move for the month of November, you benefit in all three situations by selling calls against the holdings in your portfolio. For that approach, we would look at Nifty 50 or the heavyweights in the index from the large private banking space, one, and metals, which is the other sector. If I'm not going to talk about FIIs, what they are doing in the Indian markets, it would not do justice to this webinar, because we have been tracking FIIs for long in this very platform, because one talk of the town was, why are FIIs not pouring money in the Indian markets? Now, If you look at the last 3 months of derivatives piece of data, the long short ratio had been a worrisome factor. We almost were at a point where the shorts were so aggressive in the system that you had uh, 8%, 9%. These were the numbers where the longs were compared to 90% plus shorts in the month of October and September. So that was a month where there was some pressure in the market. FIIs were reluctant to go hard on the Indian market, and things at ground level really have improved, at least in the index future segment, where the long short ratio, which starts off for the month of November, has improved from an average of 9%, which it was in the last couple of months, to 20%. So it does mean that there has not been any major long additions, but at least for the time being, the shorts have been covered up, which does give a sense of relief for the time being, at least from the data piece about the aggression of the FIIs on the short side in the Indian markets. Now, if you look at the month-wise data, on the left-hand side, you have the cash market data. The right-hand side, you have the futures market data. And in the cash markets, it's been a prevalent trend since the last 3 months. July, August, September has been month in cash markets where FIIs have been sellers. And in the index future segment as well, it's in the last 5 months, FIIs have been on a continuous selling spree. Now, the silver lining has been that in the month of September, the aggression of shorts in index futures has considerably fallen. Now, if you see the numbers, on an average, you have around 15,000 crores of selling, and 1,589 crores is the number which came out in September. So clearly, there has been a massive dip in terms of the selling intent, which has gone slow. So that can be indirectly taken as a positive move for the days ahead. So FIIs are going slow on shorting the Indian market. At least that draws some comfort or solace in the current market conditions. Now, really, the levels which I have discussed in the last 10 minutes, we like to see how markets react on Monday, because 25,700 is an important support zone for the coming week. How we react at 25,700 is important. If we hold on, we are again staring at levels of 26,200. If we break, we should be prepared for 25,400. But the way the movement is setting up, you rest assured the coming week you can expect around 250 to 300 one-way directional move. If I were to kind of pinpoint as to which way is this going, is this breaking down or breaking up, at least technically that breakdown has not happened. But contrarily, there has been last 5 days, there has been some shorting intent from the FII desk. So it's a mixed bag kind of a situation. It's a neutral setup, and level-based approach to trading is what we are completely advocating in the last few days. A couple of days, yesterday in fact, we did recommend a 25,900 4th November put in Nifty, which has worked well for us. Today we have come out with a Hero Zero basket where we have been very specific on stocks which should be bought. One of them has been Aurobindo Pharma, where one of our targets have been achieved. So you do follow our recommendations closely, and I believe you can benefit a lot out of it. Important news which you need to monitor in this current scenario, it has to be tariffs. That's the talk of the town. How US policies change with the Indian markets is what you should be looking forward to. I don't think till Bihar elections are done, till we get a clear mandate, there is going to be any major development on the India-US deals. Once the elections are done, then you can anticipate some bit of movement in the tariff updates. Whatever move which happened in the month of October, late October, was a sentimental move in anticipation that there can be a reduction or a pull-off of the high tariff structures which have been imposed on India. So that was the sentimental move, but unfortunately, till now, there has been no developments. Unfortunately, because of that delay, there has been some profit booking. Also, the Fed event which passed off in the last couple of days, the Fed again is not very keen on cutting the interest rates in the next meet. So that also doesn't bode well for short-term sentiment. So very short-term impact for the market. They are not any reversal points for the market, but they might have some pressure in the short-term scenarios. So keep a level-based approach. 25,700, how it reacts on Monday would be the key. If it breaks, we are staring at 25,400, not below that. So this is how the entire technical placement based along with derivative setup hints for the Nifty index. Keep a tab on these events. and we always make it a point to give you a strategy for our option traders who have been following us on this platform. Our strategies have worked well. It's a safe bet because you know how much risk you are taking, what the view is for the market in the current time. Accordingly, you set yourself up. So I think if you look at the broader market, it's a range bound market, and when the markets are range bound, you go for the best set strategy, which we call it an iron condor strategy. It is a strategy which defines your max loss, and we play out a range for the strategy. So as I spoke in my prior few minutes, 25 400 and 26 300 is the broader range. So that we set the strategy by selling a 26 500 call for the main November month expiry. Roughly 89 was the closing today, and we sell a 25,300 strike in put, which closed at a price of 92. So roughly by selling this call and put, you are garnering a premium of 180. This is your inflow. Now your box is set. Now you need to protect the extreme movement in case some news comes out, or in case directional move sets in. To protect or hedge against some abnormal movements, we are buying deeply out of the money call and puts. 26 900 would be the put to buy, the call to buy at 36, and 24 800 would be the put to buy at price of 35. By doing this extra buying of deep OTM calls and puts, we are also getting our margin requirement lower for this strategy. So I think this range should play off, this strategy should play well, and we are targeting roughly a profit of around 6 to 8,000 if you hold this strategy for the month end. For stop loss, you can maintain a monetary stop loss of around 5,000 as a fixed or stop loss, which you need to maintain in the system, because if you go by these levels, then the losses can be aggravated in case you don't follow a strict stop loss, because we are buying very deep out of the money calls and puts. So as a level based approach, if Nifty falls below 26,300, you can below 25,300, you can take an exit, or above 26,400, you can consider an exit. These can be the extreme stop loss levels, or monetary terms, you can keep a stop loss of around rupees 5,000 on the strategy. So with this piece of small guidance from our research desk, I wish you all the best for the month of November. We have guided you how we look forward to the index. We have given you the path. We have shown you which sectors you should be looking at, which sectors are vulnerable, how you can strategize the best using options. And I think this small webinar should be profitable for you to take your journey ahead with GM Financial.
We shall now begin with the Q&A session. How do you manage risk and trailing stop loss in options?
Okay. Look, managing risk and trailing stop loss. Options, you can manage risks in two ways, right? Trailing stop loss would be a different game altogether. So first, I will address the point of managing risk. Now, if you are managing a risk in an option trades, when you trade in options, one is you are either a buyer in options. In case you are a buyer, the worst case scenarios are known to you, because as an option buyer, your capital theoretically can be zero at the end of the month if you go completely wrong on the trade. But you know the worst case scenarios. If you're an option writer, although the probability of you getting it right is higher, but worst case scenario can be extreme, because really you don't know where you can end up if the trade goes horribly against you. So in these two scenarios, if you are to manage your risks, one I would say is follow a strict stop loss approach based on the spot charts, if it is for Nifty or for the individual stocks. So for that, you need to know technicals. You need to know some pivotal levels in the market. And if you are not well versed with such concepts, then what best you can do is, whenever you buy a call, make it a point to sell deep out of the money calls as well. We call this a bull call spread. So here your risks are managed. You are cutting down the costs of buying to a certain extent by selling deep out of the money calls. Contrarily, if you are selling options, then make it a point that you are at the same time buying deep out of the money options as well. For example, if you were to sell a Nifty 25,500 put today, you are going to cover this worst case scenarios by simultaneously buying either a 25,000 put or 25,300 put, depending on what inflow you look forward to for the month, or what is the view and how deep you feel the correction can be. But some kind of an insurance buying is a must if you are writing options in advance, so that you can deal with worst case scenarios. So this is how you handle risks If you are a writer in options, if you are a buyer in options, you follow stop loss approach based on the technical charts. If not, follow a thumb rule: 50% of your capital erosion or doubler of your trade. So 50%, suppose you buy, let's say, a stock option at a premium of 10, you keep a stop loss of 5 and a target of 20 on this trade, and follow this rule strictly. So out of 10 trades you take, even with a strike rate of 50%, you can be on the winning side. So this is one of the thumb rule of risk management which you can follow in your option trades.
Can we deploy a monthly expiry strategy at the beginning of the month? If yes, which is the best monthly expiry strategy to implement that will have minimum to zero risk?
Now, see, zero risk is very difficult to say, because we are in the stock markets, nothing comes risk free. But at least we can control our risks using options. We can define in advance as to what can be the risk if we deploy a particular strategy in options. So, if you have been a part of this webinar in the last half an hour, we spoke about an iron condor strategy, one of the strategies which I just shared with you for the month of November. So we did a historical backtesting where if you were to continuously deploy a fixed strategy like an iron condor month on month, for 12 months, you know, there will be time where you may go wrong, but then your risks are defined. So I think out of 12 months, 7 times you can get it right, 3 times or 4 times, 3 or 4 times you might get it wrong, but net you may end up on the winning side. So that is the beauty of iron condors, where you define the range. So there are two ways of approaching. One is you go with a fixed mindset in the market that this is the strategy I'm setting, irrespective of what is to happen, and you go on setting iron condors month on month at the beginning of the month. Based on historical backtesting, if you find that you are successful, you get your profit objectives met, follow with that with that approach. But my approach is always, if you're in the markets don't follow a steady single path. They keep on changing color with times, and you need to define what trend you are in. So with the flavor of the market, you have also to change your strategy. So right now, it is not a trending market. It is more of a range bound market. Be connected with us. We are there to guide you. We are there to give you an additional support to guide you on how the trend will be and how the best strategies would be for the coming month. So I think for the coming month, iron condor or a range bound strategy is what works best, and we would advise you to do that.
What will be the trend in the stock market in the coming months, and how long will the positive trend be?
Look, I think the trend on any markets depends upon the flows in the markets, right? Flows drive the market. And if you look at the flows, there has been a concern from the FII side where the flows are dwindling day by day, especially in the cash market. And on the other side, these flows are supported by the DIIs or the domestic institutions. Also, the mutual funds, SIP, if you look at, the numbers are growing day by day. There is where the support is. So I think domestically there is a very strong impetus for investing in the stock market. That appetite for stock market has significantly grown. That the investment fraternity, the investment thought process of many towards stock markets in wake of the other financial avenues has considerably shifted. And I think in wake of the flows, I think even if without the FII support, we are managing to go to the all-time highs. Let's see, in the last 6 months, we went through so many situations. We saw wars, we saw global turmoil, we saw tariff wars, and despite of all these turmoils, with the FIIs pulling out money lately, in between, still with the DIA and the domestic support and the mutual fund support, we are near all-time high levels for the Nifty index. So although your individual stocks may or may not meet the criteria, the Nifty as an index is doing its part. So I think for the broader market, if the benchmark Nifty is what we are looking at, I think the journey of the Nifty from here is positive. There may be months where it can go sideways, you may have dips, but every dip should be looked at an opportunity. So from a long-term trend perspective, if I were to put it, I'm not talking only for November. We are talking here, the question was how the long-term trend of the market is. Looking at the broader flows and looking at how India is emerging and very firmly dealing with all the resistance and challenges which is coming up its way, I think we are positioned for a very strong market in the years to come. So putting a number down would just restrict your thought process. So hence I'm not putting a target number to this.
What can help in finding an early entry in the trade? before the rise or fall on the chart?
There are a lot of parameters which one looks forward to when you were to spot at bottom fishing or identifying possible tops. Now, each individual has his own way of looking at it, but I can look at, since we have a constraint of time, I'll just discuss two indicators, one from technicals and one from derivatives. From technicals, it has to be the RSI, which is a relative strength indicator. Now, when a relative strength indicator dips below 30, right? When it dips below 30, that's the indication which shows that the stock has got oversold. Now, once it gets oversold, you have to compare it with the technical charts to see where exactly the support is, how the volume is playing out, how the derivatives data is again supportive with this. For that, we look at the option chain. We see where the highest put writing is or where the highest open interest is building up in puts. So once all these data points come together in collusion, then we come to a point that yes, this stock is ripe for a pullback or a recovery rally. And in those scenarios, we look for bottom fishing opportunities when the RSI were to cross again from 30 down to 30 up. So RSI going below 30 is the first signal for us that it is changing or it is oversold. And combining it with derivative parameters like an open interest, total open interest reading, the PCR reading, and again the RSI turning up, which would obviously happen with some price support at the lower end. This would give me a confirmation that a possible short-term base is in the making. So that is point number one. Similarly, vice versa, you can look at the tops or finding possible tops for the market. If the RSI were to cross above 70, then you look for call positions where the highest open interest is. Where exactly are they positioned? What is the PCR at that particular point of time? So all these data have to be combined together. It is not that you are going to read data in solo. It has to be in a totality. You should have your 5 parameters minimum in place and have a tick off on these 5 parameters. And if 4 out of 5 are signaling a buy, then you should be following the indicator which you have been trusting on. So that is how I normally go with my analytics, and each one is free to have their own, because finally it's the market. Everyone has can be a right on the market at one given point of time, but this is a thumb rule which I follow and it works for me, so I'm sharing.
What is the time frame that one should follow for monthly option expiry?
So I think the question is more as to if you are a buyer in option, when is the right time for buying an option, if I'm not mistaken. So right now, if I were to put it, if it all depends, you have to segregate the month. Look, first, if it's a month of trading, the first 10 days, the mid-month 10 days, and the last 10 days before expiry, these are the 3 segregations I would look at for the market. So the first 10 days is where the loss of time value is less in any trade. So you have that space where you might go wrong on the view that you say a buy and immediately it doesn't work for you. You have some space because time values don't depreciate at their best in the first 10 days. So here, when in the first 10 days, when you make a view in a stock and choose an option to buy, if it's a call option, then you can opt for out of the money calls, which are 2-3 strikes away from where the at the money is or the current spot price is. In the mid month, that is from 10th to 20th, that is the time where time value also kicks in. There is some bit of a juice in terms of intrinsic value. You can probably wait it out a little more than you could in the earlier phase. Here is where you can go for a strike, just 1 strike or max 2 strikes away from the spot in case you choose to go for any option based on your view. And lastly, in the expiry week, you have to be bang on when you try to chase momentum or pick stocks in the option space. So for here, I would strictly suggest do not go for deep out of the money call options. Stick to ATM calls or in the money call options, because here the delta factor is very important and time value is a killer. It will be completely against you. So you have to be bang on when you trade in options. So in the last 1 week before expiry, I would suggest go for in the money call buying or in the money put buying, depending on the view you make, or at least at the money, nothing beyond that. So this is a broader approach which I personally use in options trading, which we recommend to our clients.
Thank you, Akshay.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.